A recession is a significant decline in economic activity across the economy, lasting for an extended period, typically visible in indicators such as GDP, income levels, employment rates, industrial production, and retail sales. A common rule of thumb is that a recession occurs when there are 2 consecutive quarters of negative GDP growth. How does a recession occur? A recession can occur due to several factors. 1. A decline in consumer confidence. When consumers fear economic instability, they tend to spend less, leading to lower demand for goods and services. This can cause businesses to cut back on production, leading to layoffs and further reductions in spending. 2. High interest rates. When interest rates are high, borrowing costs for consumers and businesses increase. This can reduce investment and consumer spending, slowing down economic activity. 3. Inflation. When inflation is high, the cost of goods and services rises, which can erode purchasing power and reduce consumer spending. 4. External shocks. Events such as natural disasters, pandemics, or geopolitical crises can disrupt economic activity, leading to a recession. 5. Financial crises. A banking or financial crisis can lead to a loss of confidence in the financial system, resulting in reduced lending and spending, which can trigger a recession. Implications of a recession. The impacts of a recession can be widespread and severe. 1. Unemployment. Businesses may lay off workers to cut costs, leading to higher unemployment rates. 2. Decreased consumer spending. As people lose jobs or fear losing them, they tend to spend less, which can further slow down the economy. 3. Business failures. Companies may go bankrupt if they cannot sustain operations during the downturn. 4. Reduced investment. Businesses may cut back on investments in new projects, equipment, or research, stifling long-term economic growth. 5. Government debt. Governments may increase borrowing to finance stimulus measures, leading to higher national debt. How to rectify or avoid a recession. Fiscal policy. First, let's talk about fiscal policy. Increasing government spending on infrastructure projects, public services, or direct financial assistance can stimulate demand. Additionally, reducing taxes can increase disposable income for consumers and businesses, encouraging spending and investment. Monetary policy. Now, onto monetary policy. Central banks can reduce interest rates to make borrowing cheaper, encouraging businesses to invest and consumers to spend. They can also use quantitative easing, which involves purchasing government securities to inject money into the economy, increasing liquidity and stimulating spending. Regulatory and structural reforms. Implementing stricter financial regulations can help prevent the kind of excessive risk-taking that often leads to financial crises and subsequent recessions. Moreover, investing in education, technology, and infrastructure can boost long-term economic growth and resilience. Building consumer confidence. Clear communication from governments and central banks about their economic policies and strategies is crucial for building public trust and confidence. Strengthening social safety nets such as unemployment benefits, healthcare, and social services can help reduce the negative impacts on individuals and maintain consumer confidence during economic downturns. Diversification of the economy. Finally, economic diversification is key. Countries that rely heavily on a single industry or sector are more vulnerable to recessions. Diversifying the economy can reduce this risk. Conclusion. A recession is a complex economic event that can have significant social and economic consequences. While it may be difficult to avoid a recession entirely, the impacts can be mitigated through proactive fiscal and monetary policies, regulatory reforms, and efforts to maintain consumer confidence. By taking these measures, governments and central banks can help to stabilize the economy and reduce the severity of a recession.